Okay, let's go ahead and get started with the final session of the day. We'll be discussing the relationship between crude oil and natural gas prices, which has been alluded to already through the course of the day, and some implications for the existence of such, or non-existence of such a relationship, I guess. To start off, we'll have Monet Uchel. She's a vice president and senior economist of the Federal Reserve Bank of Dallas. She has many accolades, and in the interest of time, yet again, I will stop there and give her the floor.
Do you know where that pointer is?
I have no clue.
That's okay. All right, fine. That's all right. Good afternoon. Well, I'll tell you one of my accolades. I was a Rice graduate. So it's always nice to be back here at Rice, and also my son goes to Rice now, so it's double pleasure. Anyway, now this is joint work with my colleague Steve Brown at the Federal Reserve Bank of Dallas. And when we were looking at energy markets for FOMC purposes, we got this question a lot, very, very frequently, which is what is driving natural gas prices and have they decoupled? Now, this is a question that actually has been of interest to a lot of people, and you'll see that our colleagues here at Rice have also done very similar work. Now, for years, natural gas and petroleum products were seen as very close substitutes. And so, especially in the electricity sector and in industrial sector. And again, you'll see Peter Hartley's talk after one more. Anyway, industry and electricity generators switch in and out of natural gas and or residual fuel oil, depending on which one's cheaper. So US natural gas prices tended to follow oil prices quite well. However, over the past 10 years, the number of facilities that could do the switching have diminished. And so, although gas prices have sort of followed the overall trend in the upward trend in oil, we're seeing a lot of independent movement in gas also. And so, in fact, if you look at recent prices, you could think that they have decoupled. And I know Michelle just mentioned that she actually thinks they've decoupled, but I'm going to show you otherwise, or I'm going to try to convince you otherwise. Okay, this shows you, I don't have the pointer, but it's natural gas and oil prices. This is the Henry Hub spot price of gas and WTI, which is West Texas Intermediate, going back to 1994. And you can see that they followed each other quite well until pretty recently. Now, of course, the oil prices, they're not hitting the same highs. And there are, of course, a lot of episodes here where gas moves away. And here's another picture. It's a little bit more recent. It's after Katrina and Rita. And if you look at this one, you would think there's no relationship between these guys at all, actually. You think that they have decoupled. So how do we explain natural gas prices? Well, in the past, analysts looked at rules of thumb to explain the price of oil with respect to natural gas. But they don't seem to work too well, and I'm going to show you a couple of rules of thumb. Here you see two very simple rules. These are constant ratios between WTI and Henry Hub. And one seems to fit the historical data pretty well, and the other one reflects the energy content between the two fuels. The 10-to-1 rule seems to have been developed just by observation. It did describe the relationship between gas and oil pretty well in the 90s. So $60 gas, for example, implies $60 oil implies $6 natural gas. Now, the 6-to-1 rule is reflecting the energy content of a barrel of oil. And the barrel of WTI has about 5.8 million BTU. So the price of a million BTU of gas is going to be about 1/6 the price of oil. So you get, for $60 oil, $10 gas. The burner to parity rule takes into account the competition between natural gas and the petroleum product. In this case, I'm looking at residual fuel oil, but you could also look at distillate. It's based on the idea that the substitution between the natural gas and the petroleum product are competitive where they're used, which is at the burner tip. So as generally implemented, what you do is you take the price of crude, and then you transfer it to the price of the petroleum product, and then try to translate that into a product, a natural gas price, say at Henry Hub. So for competition with residual fuel oil, the burn-it-to-parity rule is going to take into account the energy content of a barrel of oil. It's going to take into account the long-run relationship between WTI and residual fuel oil, and the higher cost of transporting natural gas compared to resid. So if you take account of all that, let's sort of go through the numbers. You have a barrel of residual fuel oil. It has about 6.3 million BTU. And resid is generally priced at about 85% of WTI. And if you take into account also like a 25-cent price differential, what you get is this one and only equation you're going to see in this presentation. And what it tells you is for $60 WTI, it will give you $7.74 of for a price for natural gas. So, do these price rules work well at all? Well, here's what they look like. The bright blue is the 6-to-1 rule. The dark blue on the bottom is the 10-to-1 rule, and the red is the actual spot price of natural gas. And you can see that they don't really work that well. Now, what about the burn-it-to-parity rule? Again, that's the blue, and the actual spot price is in the red. And again, you see that the matchup isn't quite the best. So what do we do? To better explain these movements in natural gas prices, we have to look beyond these pretty basic rules of thumb. And as I said earlier, the rules of thumb are based on the switching between the petroleum product and natural gas. And if you have reduced opportunities for switching, this dynamic is going to change. Plus, it's not only WTI that affects the price of gas. We have other factors. So what are the other factors? Well, here are some other factors that might affect the demand for gas and hence the price for natural gas. Extreme weather events, seasonality, storage, and disruptions to production such as happened during hurricane season and so on. So what we're going to do is, well, first of all, let me look at these in a little bit more detail and then I'll explain our model. Here is production of natural gas back to 1980. What you see here is that production until like the mid-90s was very seasonal. And basically what it reflected is the seasonality of consumption. Now what happened after the mid-90s is that we started using storage more. So the market has made a move from seasonal production to basically a storage market. Now then, if you look at storage, you see the seasonality there. And because the consumption is seasonal, what happens is that you build up storage in the summer, you use it up in the winter, and what you're seeing here, this is a basic DOE EIA chart that comes out. I don't know, is that weekly, Glenn? So what this is basically the green line is the 5-year seasonal average of storage. And the band, that blue band, shows you the maximum and minimum of storage for the 5 years, average, 5-year average. And if you put the red, this is the actual gas in storage, you see where you are. And today, for example, well, last week when this chart was made, the actual was about 9% higher than the 5-year average. And I think this week, yesterday, it went down a little bit, 8.4 or something like that. But still, we're above our 5-year storage average. So what we do is to investigate the influence of all these variables, WTI, which is the oil price, but also weather, seasonality, storage, production disruption, and so on. We put all these variables into our model. We use weekly data. We study the period from 1997, June of 1997, to July of 2007. And why we can't go back, this is weekly data, and one of these variables, and I think it was heating degree days, I'm not quite sure, does not go back any further than 1997. So this is where our weekly data starts. Now, what actually do we use in this model? Here are the actual variables that we use. So the price of gas is the price at Henry Hub. Price of oil is the price of WTI. We have heating for the extreme weather events. We have the heating degree days, deviations from normal heating degree days, cooling degree days, deviations from cooling degree days. And then we have a storage differential. So how far are we from the 5-year seasonal norm? And then we have a variable for shut-in production, which takes into account those days with hurricanes where production was shut in the Gulf. And this is not a volume, it's just the days, binary. So, and what would you expect with these variables? Basically, if you have extreme weather events, you expect the price of gas to be positively affected. If you have a storage differential, if it's higher, then you expect the price of gas to be depressed. If it's lower, you expect the gas to be boosted up, and shut-in production will boost up, of course, boost gas prices. So now we do all kinds of econometric testing that I'm not going to get into here. But just rest assured that we've jumped through all the hoops and that the analysis is correct. And believe me, you'll thank me for not going into all this. But I will go into what we find. What do we find? First of all, we do find, sorry, Michelle, crude oil and natural gas prices do move together in the long run. What does this mean? It means we call it cointegration in econometric jargon. And what it implies is that gas and oil can't really wander off too far away from each other. If something happens and they move away, they will adjust back to their long-run equilibrium. Changes in crude oil prices lead changes in natural gas prices. This we call causality. And this goes one way in our model. We did find that changes in natural gas prices lead changes in oil. So it's WTI leading Henry Hub. And the other is that if the two prices move away from each other, the relationship is restored about 12% per week. So you get about 19 weeks, they close up 90% of that differential. What about the rest of the variables? These are significant variables, which means that they add something, they have some explanatory power for the model. What you see here is the plus or the minuses are how an increase in the variable affects the price of gas. So basically what you're seeing is if the price of crude goes up, gas price goes up. The extreme weather events make the gas price go up. If the storage differential is higher than the seasonal norm, the price of gas falls or is depressed, and shut-in production affects it. So these are all positively. So these are all as expected. These are consistent with our expectations for how these should behave. Now, I'm not going to give you any numbers here in terms of, I'll just give you one thing. After crude, the most important variable was the heating degree days in this equation. Now, I'm going to show you, though, if we do a good job tracking the gas price or not. And if it didn't, I won't be here, right? So it actually does a very good job tracking the price of natural gas. You can hit all those highs and lows, most of them anyway, with this model. So it really does do a very good job. Now what you see here is, wait a minute, I have one more, I think. Where's that one? Okay, here it is. Let me show you one thing though. Let's see what the model says about natural gas prices going forward. And I'm not going to go forward too much, just a year. If you just took the oil price relationship, if you just took the long-run relationship with oil from the model, then what you get is that black line. And you see, it's sort of like those Burnett to parity rules or the constant ratio rules. You don't hit all those highs. What you get, though, is that relationship. And the model says that if you didn't include all the other variables and just used the WTI, you would get, let me see what the price, you would get about, let me see what I did with this number. Future market says it's $8.85. The long run relationship with oil puts it about $11.94. So it's quite a bit higher than what the futures market says the gas price is going to be, or for December '08. Now, if you put the rest of it in, though, if you put the full model in, and this is sort of going out again a year, so what you have is the futures market, which is the red, and then you have our model, including not only the long-run relationship with oil, but also the rest of the exogenous variables. And you see that it's a lot better fit. In fact, if you go out to the end, December, they're almost the same, 885 versus 883, something like that. Now, one thing here, what does this assume? It takes the oil price from the futures market, and then it's the conditional outlook, so it's also based on normal weather and normal storage. So that is actually one reason why you see that hump. Maybe it's a little bit more seasonal because we take normal storage, whereas storage now is like 9% higher than average. So that's one of the reasons it's sort of a little bit higher. But as you see, it does a pretty good job. So I'll just wrap up. So simple rules of thumb don't really explain natural gas prices too well, but we find that a model which includes not only oil prices, but also accounts for weather, storage, and production disruptions seems to explain natural gas prices quite a bit better. Gas prices are not decoupled from oil. The substitution between gas and petroleum products seems to be what links the two in the long run. And the gas price is anchored to oil prices in the long run. So it comes back to that relationship. But the short-run dynamics are determined by other variables, such as the ones that we use in our model, weather, storage, production, and so on. And the linkage is likely to continue for some time. And we'll see the Hartley and Jennifer's papers to sort of shine a little bit more light on that. So I'm going to go. I have to have this water. So thank you. So that's it. I think I'm fast, right?
Yes. Okay. Thank you, Monet. So next up, we have one of our homegrown, Jennifer Rossall. She is a graduate student fellow in the Energy Forum at the Baker Institute and a graduate student in the Economics Department, hopefully finishing her PhD up later this coming year. So, Jenny, the floor is yours.
So a lot of the first part of this is going to look very familiar. We use similar techniques to what Monet just introduced to us, but I'm going to give you an idea of where we differ in our analysis. So first of all, I will go into slightly more of the technical detail. There's a couple more equations, but not too many. I'll give you motivation for why we're doing the work, our methodology, data, our results, and then some final conclusions. So first of all, why focus on natural gas and oil prices? I'm going to move through this quickly. We've kind of already been through it. Historically, there was this 10-to-1 ratio, but some have started questioning whether or not there's actually a relationship that exists in the long run. We are interested in this for a lot of different reasons: investment planning, futures trading, and so what we're trying to figure out is what drives this relationship, if there is one at all. And Monet already touched on the idea of substitutions, especially in the electricity market, and this is going to be where we primarily differ in our research. And this energy content relationship that she touched on with the burner tip parity. So this looks very familiar. Our research looks at how natural gas prices respond not just to WTI but to residual fuel oil. And so here you can kind of see that they've basically followed the residual fuel oil price. with the spikes that, as Monet already told us, can be explained by exogenous factors. And a lot of people have asked whether or not this period in the end illustrates the fact that these prices are decoupling. The error correction model. The basic idea is that we're going to estimate this long-run stable equilibrium relationship, and then we add in exogenous variables to account for what drives us apart from this long-run relationship. So the research strategy is, first we identify this relationship. We use two different econometric techniques to do it, ordinary least squares, which is the basic regression analysis, and then a vector error correction model, which is a maximum likelihood technique. We then identify the shocks that cause departures from the relationship, and we estimate the adjustment process again in two different ways. And I will show you actually that these end up being very similar in their results. So here's the primary difference. How does the electricity sector influence this relationship? So Monet touched on the fact that the reality is that there aren't very many plants that can switch between fuels, and that this represents a relatively small sector of electricity. Peter's going to get into a lot more detail on this. And so that part might be important, but there's another way in which fuels can compete, and that's at the grid level. So first, we look at two different ways Peter will talk about, and one's the plant level switching, but the second is the grid level switching. And what I mean by that is plants moving within the supply stack to compete. So what ends up mattering is, first of all, residual fuel oil, because this is where the competition actually takes place in the electricity sector. And secondly, the technology in the electricity sector. The fact that natural gas combined cycle plants have come online in the last 10 to 15 years accounts for a major improvement in natural gas efficiency in the electricity generation. So we can calculate the actual cost of generation. So rather than just looking at the fuel price as the input, we calculate the cost of generation, which is a function of the fuel price at the bottom there, times the heat rate of the facility. Give you an idea of the data we're working with. We're working with monthly data rather than weekly, and we have natural gas prices, Henry Hub, fuel oil prices, and WTI prices, all from the EIA. We convert prices to real values based on the electricity output price. This is based on the idea that this is where the primary competition between the two fuels occurs. Heat rate data. This was constructed from two different databases, the EIA and the EPA. The EIA keeps track of all the facilities when they come online, their capacities, and the EPA has data on each plant's heat rate. Some of it is actual heat rate data, some of it was assumed data because of proprietary reasons, but what happened, we basically just merged the data sets and came up with an aggregate capacity-weighted heat rate average, which I'll show you in just a minute. Other variables, again, very similar. Beginning of month storage levels, degree days to account for demand due to heating and electricity used for generation. And then we also have a variable in there for extreme heating degree days, which basically just looks at the top decile of heating degree days. So was it actually, not only what was the actual heating degree day value for that month, but was it in the top 10% of all heating degree days? We constructed a variable, again, to represent Gulf Coast hurricanes to look at the effect of shut-in. And then the Chicago February 1996 incident was an especially cold winter in Chicago. We used a dummy variable to account for that. And then we have monthly fixed effects just to look at how different months play into the relationship. So the heat rates. We calculated, like I said, capacity-weighted heat rates, the equations there. And this is basically what we find, is that starting in the late 1990s, we see a drastic decrease in the heat rates, so an increase in efficiency in natural gas electricity generation. But we don't see the same in residual fuel oil fire generation. And so the basic idea is that this long-run relationship is driven by the cost of generating electricity rather than just the input prices of the fuels. Stationarity and cointegration. The basic idea is that if you have two variables with trends and you do basic regression analysis, you might end up with a spurious relationship. They're going to look related when they're not actually. So basically what we do here is we look at cointegration, which Monet already discussed, and the econometric idea behind it is that you do a regression analysis, and if the error term is stationary, meaning that the, I don't know how to describe it. well, yeah, mean reverting. But then it represents a long-run relationship. So, first of all, the relationship that we estimated using ordinary least squares, we just looked at natural gas with the relationship on the price of residual fuel oil and the ratio of the heat rates to account for this technological change over the last 15, 20 years. And we found that it was in fact a co-integrating relationship. It was a stable long-run relationship. And we also found that residual fuel oil and West Texas Intermediate price have a long-run relationship, which is no surprise. What we did find, however, which is slightly different, primarily I think because we're using monthly data over a different time period, so it's not contradictory to Monet's work. What we find is that if we omit the relative heat rates, it's actually not a long-run relationship anymore. We do find, in fact, that the error term is not mean reverting. So what does it mean? We can bundle those two equations together and we come up with a relationship between oil and natural gas. And we basically find that at $50 oil in 1990, you would have had about $4 gas. But in 2000, you can have more like $6 gas. And the reason behind this is that they can still compete in the electricity market because the natural gas-fired generation is so much more efficient that the price of the fuel might be higher, but they're still competitive with one another on a cost basis. So the second way we calculated it, we again came up with stable long-run relationships. This is a different econometric technique that we used, but we found very similar results, which is encouraging. And these are the final error correction models. So this is, I won't go through it too much. Is it even legible? But the basic idea is that either of the two methodologies that we use, we find that there is in fact a long-run relationship when you account for relative heat rates. We also find that regardless of the two methodologies econometrically, we end up with basically the same results. We find that natural gas prices, the change in natural gas prices, responsive to that long-run deviation. So that means that if natural gas price is relatively high, given the long-run relationship, the change in natural gas price will be negative. So it's going to revert back to that long-run relationship. We also find that it is natural gas that does the reversion as opposed to residual fuel oil. And in the case of the residual fuel oil WTI relationship, we find that it's the resid that reverts back to the long-run relationship. Again, we find the same thing that Monet found, that all the exogenous variables have the expected signs. I'll skip that because it's a little more technical. Impulse response functions. Basically, what we measure here is what is the effect of a shock in one system or in one price to another. So the top left graph is the effect of residual fuel oil shock on natural gas. And we see that we basically revert back to, that we have a one standard deviation shock in residual fuel oil is going to give a 0.6% shock to natural gas prices. And we find that that decreases over time. However, the effect of natural gas on residual fuel oil is, first of all, much smaller. It's statistically insignificant with the exception of 1 month. And so from that, this is one of the ways that we can conclude that it is, in fact, residual fuel oil that's driving natural gas as opposed to the other direction. So basic results, all the signs were expected. One thing that's interesting to note, we actually tried to quantify in our hurricane shut-in factor the amount of production that was shut in. And what we found is that for 1 BCF shut in from hurricanes, that leads to approximately a $1.03 MMBTU increase in natural gas prices. And again, the primary thing that we can take from here is that the technological changes in the electricity sector actually do incorporate into this long-run relationship, and that we have a chain of causation that goes from WTI to resid and then to natural gas. And that's all.
Thanks, Jenny. Okay. Next up is Peter Hartley. He is the George and Cynthia Mitchell Chair and Professor of Economics. And he also works very closely with me as a Rice Scholar in the Baker Institute. So closely, I think, I found out actually last week we both spoke at a conference, and I missed the morning session, so I don't know what he said. But I walk in and I do my presentation, and he's chuckling. And I afterwards asked him why. I said, well, we said some of the exact same things. I was like, oh, goodness. So anyway, Peter, the floor is yours.
Okay, thank you very much. First thing I would like to say is, as part of this study, I think it's already been mentioned this morning, but I'd like to emphasize again that we're very grateful to McKinsey for helping finance this research. But not only did they help with us pay for Jenny while she's still a student, they also were very helpful when we were working on this material, that we had a number of meetings and spoke with them and bounced ideas off them and so on. So I want to thank them very much for that as well. Just to sort of recap a little bit, Minay talked about this relationship between oil prices and natural gas prices. It was a shorter period that she looked at with weekly data. Jenny's looked at a longer period, and looking at the longer period with monthly data, we had to use monthly data because the heat rate's only available monthly. She's got the link there again, but now we had to include these relative heat rates to maintain a link. Now, it's not contradictory, I think, with Minay's results because Jenny's looking over a much longer period. So, but when you go to that longer period, what we found is, or what Jenny sort of just showed you, we found is that you've got to include these changes in technology in order to maintain this long-run relationship. So, and then we've got, because of that change in heat rates, you get this change in the long-run relativities that the prices are tending back towards. So now what I'm going to talk about is that we want to go a bit further than that. So we've got this relationship now that's based on competition in the electricity industry. That's what the cointegration analysis suggests, that it's residual fuel oil that's important, and we've got this electric plant heat rates that are explaining this deviation or apparent change in the relationship. So, but we're not content with that, so we want to test that hypothesis some more. So the question then is, can we get some other data and really look at this and see if there is significant evidence of this substitution between gas and oil in the electric sector? And so that's the next part of the exercise that I want to talk about. So, you know, we got a hypothesis, we want to probe it some more and look at this, this question. So basically then the idea is, does a micro level analysis reinforce the conclusion? And it ought to be the case theoretically, but of course does that necessarily mean it works empirically? And to do that, we looked at the data based on the various NERC regions and sub-regions in the US, again over the period January 92 to March 2006. And there's a map of the actual regions we looked at. So mostly these are the NERC regions as they were in 2006, except that we split off VECM from CERC, and we split NPCC into two, the New England ISO and New York, and we split WECC into two, California and the rest. And we joined the two SPPs actually. But basically it looks like each of these NERC regions. And what we're going to do is look at the substitution between gas and oil, particularly residual fuel oil, natural gas and residual fuel oil in each of these regions over this time period, see if there is significant evidence of this substitution that would drive the kind of relationship that Jenny found in the aggregate data. And she already mentioned that there are two ways that you can have substitution between the two fuels. One is switching, but it's not the only way, and this illustrates the movement in the stack that Jenny was talking about. So in these two pictures, we got sort of a representation of the stack of electric generating plants, depending on their costs, short-run costs. And at a relatively low natural gas price, the natural gas turbine is below resid, and at a higher price, it's going to be above resid. So you can have substitution between these plants within the system as a result of changes in the prices and movement of the plants on the stack, as well as actually just switching within a given plant. The second key idea, as Jenny's already mentioned, is this idea that we've got the heat rates changing over time, and that technological change is altering the long-run relationship between the prices. Again, Jenny mentioned this, but she did all this hard work of going back to the two databases and calculating all the heat rates, and we get the capacity-weighted heat rates, and also we can get these capacity-rated costs of generating electricity using the different fuels. There's a little bit of detail there. We did this not only for natural gas plants, but also for the various oil burning plants and coal plants. And and as Jenny mentioned, we looked at a relationship between the two costs. So this is another way of writing her equation, which we don't have the pointer here again, but that equation has built into it this relative heat rates idea that Jenny talked about. It's just another way of writing the same relationship. But now what we do here is we estimate this relationship. We allow a variation in this long-run relationship across the different NERC regions. So one thing you might expect is that there would be persistent basis differentials, for example, across the different NERC regions, and the configuration of plants in those regions would be adjusted to respond to the average prices, if you like, or the average costs of using the different fuels in each region. So you wouldn't necessarily expect exactly the same co-integrating relationship in all the regions. And that's exactly what we found. Put it another way, you might expect the price of relativity that the prices go back to vary a little bit from one region to the next. Just because they're adjusted, the plants, configuration of plants would be set up to respond to the average kind of price differences. We found that, and just as she found at the aggregate level, that basically the oil cost is non-stationary and so is the natural gas cost, but because these things are co-integrated, there's a relationship between them where this non-stationary element cancels. And if you look at the right-hand side, all those zeros everywhere, that's another way of saying that we've got this very strong evidence of this strong long-term relationship between the oil costs and the gas costs once you, in other words, the prices, once you adjust for heat rates. This relationship is also very present at the NERC level. And the two columns here, the beta coefficients, you see there's a slight variation in this relative price relationship region by region. And then if you look at the literature, so what we want to do, I guess, to go back, we're going to look at this, to see if there's any of this strong substitutability between these two fuels in the generation of electricity region by region. And if you look at the economics literature on this demand for fuels in electricity generation, there's a very long history of people looking at this econometrically. The standard approach that people have used is to estimate what's called a translog function, which is actually a quadratic in the logarithms of the various variables that are driving. And one reason people did this is they can say, well, mathematically you can think about a quadratic as a second order approximation to a more general function. So this could be used as an approximation to a very general functional relationship between these variables. That's sort of the justification. So we do that, and we got asked some very good questions by the McKinsey folks, which is, Ankush in particular. Why would you want to use this logarithmic function and so forth? So we thought about that some more. I'll come back to that point. But the general point here is a quadratic should be an approximation to a more general function. So unlike the previous literature, we've got a few different elements to our approach. So we follow what a lot of these other people have done to start with. And one big difference is, of course, we've got a panel. So we've got these different regions, and we're following them over a long time period. So we have both a cross-sectional element and a time series element in our analysis. Most of this previous literature, people have just looked at a point in time and just looked across the different regions, rather than looking at both the time element and the cross-sectional element. Now, of course, one difference is we're doing our analysis where we've got a lot more data, and we've got a lot more recent data, we've got better data, and we've got a much longer period with everything being deregulated, so it makes sense for us to look at the time element. So I'm not really knocking these previous guys for not looking at the time element, but still it's a big difference. Plus, we've got this evidence of this co-integration relationship. We've got to work that in, and previously people didn't do that, but that's, again, there's only a very small number of studies that actually looked at the time series aspect, but those that didn't take account of this the idea that these prices are tending back to some long-run stable relationship. And then again, because we've got this time element, we've got to allow for this dynamic adjustment that both Mine and Jenny talked about, but we're doing it at the local level. Anyway, we estimate this, I guess it's even harder to see all those numbers, but we estimate this relationship in the translog, and what we find actually is if you look, this is the key variable, this is the deviations in the price relativities, and the dark ones here are ones that are statistically significantly different from zero. You do get quite a few of the regions where there is a significant negative response to an increase in the gas price above its long-run relationship with the resid price. However, we do find one case here in California where it goes the wrong way. And some other problems with this thing is we find, for example, in Florida that it's not significant. So this FRCC is not significant. And that doesn't make any sense because we know, in fact, there's a lot of switching capability in Florida. So, this shows that there are problems with, we think that shows that there are problems with this translog kind of relationship. And a lot of people just sort of use this because it's, as I said, the sort of the standard approximation. Well, to look at that much more carefully to see whether there's a problem, we also did an analysis where we actually looked at the plant level and looked at plant level switching. And in the database that we've got, there's actually 167 plants with 136,000 megawatts of capacity, which is 18% of the generating capacity in the United States, that actually use more than one fuel over this period. So that's approximately 13% of that capacity actually is in industrial cogen. But there's actually a lot of switching capacity in the US over this period. And most of it, or a lot of it's on the East Coast, or I should say much of it's on the East Coast. Actually, here's the distribution by those NERC regions. Actually, every NERC region has some plants that are multiple fuel plants. A lot of them actually are multiple fuel, dual-fired, distillate and natural gas. 28% are resid and natural gas. And there's some here actually that are triple fuel. They use 3 fuels over the period. And what we did is looked at the percentage of natural gas consumption over natural gas plus oil consumption in each month in those plants, measured on a BTU basis, and examined to see whether that was significantly related to the relative prices. So is there a response to these relative prices? Again, allowing for the weather variables and the monthly effects. And then we allow for the lag-dependent variable here for this slow adjustment. And then we've got to allow for the fact that in some months these plants burn only natural gas, other months they burn only oil. So sometimes this variable is 1, sometimes it's 0, sometimes it's in between. So in order to do that, we've got to have another econometric technique which is known as Tobit estimation. So when you do that, what you find is that there's a very strong response in these switching plants to natural gas prices and residual fuel oil prices and distillate prices. And it depends, in either case, whether you've got the plants that use both natural gas and distillate or the ones that use natural gas and resid. Each case is strong evidence of switching. And then when you put them all together, again, we have strong evidence of switching, but the evidence is actually that the resid price is a stronger effect. And now if you look down the bottom, you'll find that there's actually also a considerable number of plants that are using only gas or only oil in some months. So the Tobit estimation really matters. So the interesting thing about that is if you look back, so we've got this information that there's a very strong effect of prices on the plants that actually switch. A lot of those plants are in Florida, and also the Middle Atlantic, and so on. Yet the translog analysis didn't tell us that. Plus, we also had some prodding from Ankush. Why are you estimating this log function? Why don't you think a bit more about what's going on? So it was very helpful. So we thought about it a lot more, and the basic point is we said, okay, well, maybe there is a better function. So if you think about what goes on in this setup, if you have a very, very low price of, let's say, oil, then we expect a low use of gas capacity. And hardly any of the gas plants will be used. And then as the oil to gas price increases, there'll become a point where you'll switch to a lot of the natural gas plants, But then once you've got all the natural gas plants operating, you can't switch to them anymore, so this should flatten out again. So you should have a functional relationship that has some kind of S-shaped. And so we came up with such a functional relationship. Here it is right here. We called it a double log. But, when you estimate that, also allowing now for the total generation as a control and the weather variables and the seasonal effects, basically what we get is this. And what do we find? Lo and behold, Florida is now at the top of the list. So again, we've got much stronger evidence here of substitutability. In fact, the sign of this effect is consistent. In all cases, it actually shows that as the relative price of gas goes up, you use less gas for power gen in all of these regions. But some of the ones at the bottom aren't statistically significantly different from zero. That's why they're grayed out. But they are all the posited sign. We also have the significant weather effects, just like we saw at the aggregate analysis. Plus, we have this dynamic adjustment process, somewhat like was seen at the aggregate analysis. And if you want to know what that function looks like, this is what that function looks like right here. So this is a three-dimensional picture. We got the real gas cost along this axis, the real oil cost on that axis, and this is the our dependent variable here, which in this case is the actual amount of gas that is used in the month relative to what could be used if the plants that were available were used 24/7 throughout the month. That's how to interpret that variable. So it's sort of a fraction between 0 and 1. And what you can see is that if you have, of course, a very high gas cost, very low oil cost, we're down here, we're not using much gas plant. If you go up to the low gas cost, high oil cost, you switch, and you get very high switching up in this corner. So it's the sort of shape of that surface. To also put some numbers on this, so when we talked about this at McKinsey last time, they said, well, you want to have some more numbers about what this means. It's another good suggestion. So we've followed their question again. So I've got the numbers for them this time. So the mean values for all these variables, I should say, first of all, the natural gas consumption fraction averages about 11.8%. So if, in fact, the plants burn about 11% of what they could burn if we ran them 24/7. The minimum is 0.088%, the maximum is 71.53. Now, if we have a 1% increase in total fossil fuel generation above its mean, it raises this fraction by about 0.098 percentage points. One standard deviation increase in this relative price reduces the fraction by around 0.39 percentage points. So is partly why this relationship takes quite a few months to get back online, back into line, because this is not a strong effect on gas burn. However, this is rather interesting. One standard deviation in cooling degree days above their mean actually raises this natural gas consumption fraction by around 4.8 percentage points. So if you think about that, you could go, for example, from 5% to 9%. So it's actually quite a big effect from the weather variables, which actually justifies, I guess, why all the traders focus so heavily on all the weather variables. It comes out in this analysis. Okay, so finally, some of the implications of the results. Key regions for arbitrage between these gas and oil prices, the driving the aggregate relationships that I've already mentioned. Florida, Virginia and Carolinas, Mid-Atlantic, Maine, MAP and New York. And also, to some extent, Illinois, Wisconsin, Iowa and Minnesota. A few more have reasonably large responses, but they're not statistically significant. Some of the other ones have the right sign, but they're rather small. It's particularly the West Coast and New England don't really seem to play much role. A rather surprising result we found is ERCOT. In our analysis, ERCOT doesn't come out as statistically significant. In the Translog analysis, funnily enough, it did. And it's rather interesting that the difference with the Translog analysis, we're able to test for coal. But the interesting thing is that our analysis suggests on the whole that gas plants, and maybe there's some electric people here can help us, but on the whole gas plants and coal plants are complements. So when you tend to be burning more coal, you also burn more gas, and both of them are substituting with oil, which is sort of interesting. That's what the econometrics says. Let's see. And then as I mentioned, the weather variables are very important. Overall, I'd say the disaggregate evidence supports the hypothesis that power sector plays a key role in maintaining the long-run relationship. Our overall results are consistent with the market focus on price relativities between natural gas and oil being re-established over the longer run, but also consistent with the idea that weather shocks in particular can drive us away from that in the short run. These results are consistent with the market focus on weather shocks, but they're all consistent with the aggregate results. Thank you very much.
Okay, I believe our next two speakers are going to tag team. So we have Ankush Kumar and Tommy Inglesby, both associate principals at McKinsey & Company. Tommy is a leader in McKinsey's North American natural gas practice, and Ankush I was reading through your bio, a lot of experience in assisting not only strategy, but different companies dealing with changes in regulatory structure, even one national oil company, which I'm curious what that is. But so I'll turn the floor over to you guys.
Thank you, Ken. What we wanted to cover today was two things. We wanted to talk about a little bit about some of the techniques that we are using to get a market perspective on long-term gas prices. We've talked a lot about relationship between crude and natural gas. We wanted to start off a little bit about some of the techniques that we're using on what are the markets really saying about the consensus about long-term gas prices. And then Tommy will talk a little bit about some of the fundamentals that underlie and potential fundamental scenarios that could define the long-term price of gas and their linkages to oil. And then we'll open up the floor for questions. So this is a version of a chart that we have seen at various places, but basically what this chart shows is the forward curve, the spot prices of gas and the forward curves. The wriggly lines that lead out from the solid blue line are the forward curves. What we see is historically, if you look at the forward curves, they were kind of driving towards a common mean of somewhere in the range of about $354 of gas price, indicating a long-term mean, which is the previous future range as it indicates. Even when the spot prices were very high, the forward curve would decline and indicate that there was a long-term gas price somewhere indicated around $4. Now we have seen a structural shift, apparently, where the forward curves tend to be converging around a much higher number, around $7. And lots of external estimates kind of put a range of around $6 to $8 for long-term gas prices. What would be cool is, and that's something that we tried doing, is what would be cool is, what do the capital markets really believe about this long-term gas price? We believe, and we have tried doing it successfully, is the long-term, long-lived E&P assets tend to have long-term gas price embedded in their company valuations or asset valuations. So deconvoluting the valuations of asset deals or company valuations which have long-lived gas assets would give us a long-term gas price. So here's a technique that we use, which is largely, we start with developing a production profile for an asset base over a time. And so this is a case where for an asset deal, we saw that the production profile would extend for the next 30 years. And we then run various scenarios of gas prices with different long-term gas price assumptions and try to match the long-term gas price scenario that would lead to a valuation of the deal which is consistent with the market. So in this particular deal, you see that we ran 3 gas price scenarios: a long-term gas price scenario of $6.75 per MMBTU, one at $8 per MMBTU, and the other one at $5.50 per MMBTU. The 3 converged, and the 3 gave a result of, one gave somewhere around $1.8 billion for the asset deal. The other gave somewhere around $2.5 billion. But the actual asset deal was $2.2 billion, which kind of indicated that the long-term gas price embedded in that deal is about $6.75. We did the similar valuation for multiple deals and multiple companies. Not only E&P companies, but also merchant utility companies that essentially have a long-term gas price driving their valuation. And surprisingly, for most of these companies, we get a narrow range of gas prices long term, somewhere in the range of between $650 per MMBTU to $750 per MMBTU, which kind of indicates to us that some of the projections and some of the where the forward curves were ending all kind of converge to a market common view of gas prices around $650 to $750 in the long term, average gas prices. The next piece that we wanted to understand around this was, however, this is the mean expected, but there is a lot of deviation and potential variation around this long-term gas price. Do the markets tell us the probability distribution of gas prices around this expected mean? What's the probability of gas prices being below $3? What's the probability of gas prices being above 14? And what are the markets really telling us? To do that, we took data from the options being priced in the market, in the traded markets, and back calculate the volatility, and then use the stochastic model using mean reversion and the volatility and the long-term mean expected prices to develop a probability distribution which gives the band. So to interpret the chart on the right-hand side, the black solid line is the mean expected gas price, which is in the short term, the forward curve, and in the long term, the one that we calculated using the 650 to 750 mean range. The light blue shade is a 1 sigma deviation probability distribution of gas prices. The dark blue gives a 2 sigma. What this tells us is, based on the current markets, in 2018, the markets are saying that there is less than a 5% probability that the gas prices will be above $13, and less than a 5% probability that the gas prices will be below $350. Contrasted to something if we had done this similar analysis 3 years, even 3 years back, the probability that the market would have said that the gas price is $350 would be somewhere in the range of 30% or more. So we believe that this technique can be used to develop a distribution in the probability of what the gas prices can be, which is critical to various asset valuations and asset deal and capital investment decisions. I will now hand it over to Tommy to talk about some of the fundamentals and the linkages to gas prices.
So as we move into this last piece, I mean, the starting point for us was the analysis that Ankush has just walked through. If you take a look at, in the discussion we've just had, take a look at the pricing that we've talked about kind of over and over again during today's discussion. The market has embedded an expectation of gas prices in the $6 to $8 range long run. At the same time, crude oil prices, long run forecast for crude oil is around $70. If you assume roughly 85% ratio of residual fuel oil to crude oil, that implies a roughly $9 natural gas price out over the horizon, which is actually very different than what the market is expecting today. So there's a disconnect that has begun to open up, which is we've all spent the last hour and a half talking about a link between gas and fuel oil. The market is actually expecting something very, very different, which is a disconnect in the long run and a shift back to gas-on-gas competition. In today's environment, and that's to get into that $6 to $8 range, that is kind of a gas-on-gas world. We are delinked from crude and gases pricing up to resid and then down off of that. If you believe in a continued crude-linked world, a link to resid, a shift up towards kind of the 85% resid to crude ratio, that implies a roughly $10 gas price. So what does that actually mean going forward? So beyond just talking about the outcome, what's actually driving this price setting going forward? What do you have to believe for either of these outcomes? First thing we went and looked at is say, what's happening on the demand side? I have to take a point of view on how gas demand is actually likely to develop over the next 10 years. The biggest driver of that's what's happening in the power sector. And in the power sector, we have an expectation looking at expected power load growth of somewhere in the range of 100 up to 200 gigawatts of new capacity that needs to get built over the next 15 years in the US without significant improvements in energy efficiency. So this is kind of painting a world that is a status quo world. And if you look at today, take this $6 to $8 gas price range, what's the economic fuel of choice for building that new capacity? Everyone talks about renewables, everyone talks about nuclear, everyone talks about coal. We'd all love those as options. If I look at demand growth over the next 7 to 8 years, coal and nuclear, both from a timing point of view, but also from a what's the break-even economics. If the world consensus is around $6 to $8, gas continues to be, in new combined cycle capacity, continues to be not the option of choice per se, but almost the option of default. I'm running into a capacity tightness. I'm short in my market. Reserve margins are tightening. I need new capacity online in 18 to 24 months. I can't build coal or nuclear in that time horizon. So you end up in almost a trap of, I keep building gas even though I don't want to, over and over and over again this time horizon. We begin playing that out to kind of the time horizon of 2015 and look at other sources of demand. We've talked about power. You talk about demand growth for oil sands, which is somewhere in the range of 4 to 5 billion cubic feet a day of additional demand to be supplied to oil sands. You start talking about ethanol and other biofuels. A 17 billion gallon a year mandate for ethanol is an additional 2 to 3 billion cubic feet a day of natural gas consumption. You begin adding all of those up to say we've got demand across North America of about 70 billion cubic feet a day in 2006. Traditional growth, and this is just residential and commercial. We've in this case said no industrial growth. Let's be conservative and just say no additional industrial growth or erosion in the U.S. The power sector, and in this case that assumes that we do meet a renewable standard, a 7% renewable standard across the entire U.S., and we build about 30 gigawatts of new coal capacity by 2015. It's still somewhere in the range of 10 to 12 billion cubic feet a day of additional gas, assuming it all gets met by efficient new combined cycle. You add in oil sands, you add in ethanol, it should be 2015, looks like a 95 to 98 billion cubic feet a day gas demand across North America. At today's current supply of around 70, that is a substantial gap that puts us in an environment of kind of continued demand destruction. And demand destruction is what actually drives the link to refined products and residual fuel oil. It's operating on that environment where we're constantly having to destroy some amount of demand to clear the market. So we begin talking about how do we meet that supply. So we've got this gap. We've got offshore production, Canadian production, existing onshore production. There's a gap that has to be filled. Some amount of that will come from U.S. onshore production. To fill the majority of that gap in the U.S., we'd have to shift from drilling 30 to 35,000 gas wells onshore in the U.S. to north of 70,000 onshore wells a year over the next 7 years. It's actually pretty difficult to achieve in this time horizon, not just from a rigs, but especially from a services and permitting point of view, which leaves us in an environment where we're forced to draw LNG. The U.S. is trying to draw LNG out of the Atlantic Basin. And we're no longer in a world 3 years ago or 4 years ago of short regasification capacity. We're actually arguably long regas. We're short liquefaction across the Atlantic Basin. And in that environment of being short liquefaction, that liquefaction, those LNG volumes sitting out in West Africa, are going to go to the market of highest value. They're not pricing at marginal cost. They're pricing at alternate market. And so if the U.S. is competing for those volumes, it has to be willing to pay at or more than what Europe is willing to pay for those volumes, because Europe is trying to consume the same volume of natural gas as the U.S. is. So you end up in an environment where that actually, interestingly, begins to reinforce some of the same pricing dynamic of linkage to residual fuel oil that we've talked about, but actually not through the demand side. So we've talked about it up here historically through some level of distillate switching, as we called it, power dispatch or grid switching, and then interrupt plant resid switching. That's historically been sufficient on the demand side to drive a link between the gas market and the oil market. You actually end up in an environment here where beyond just that, you actually have a big source of supply that comes in and out of the market at resid-linked price, and that's these LNG volumes. Europe contractually pays for LNG at residual fuel oil. That's how Europe buys LNG, signed under long-term contracts. They've got a rolling price arrangement, but it's a long-term supply deal that's linked to residual fuel oil. So for the U.S. to attract LNG volumes out of the Atlantic Basin, the U.S. has to be willing to pay resid or above. If U.S. prices drop below resid, that volume diverts out of the U.S. and goes to other markets, Europe or Asia. If the U.S. pays above resid, that volume diverts out of those markets and comes to the U.S. You end up actually, for at least this time horizon, and under this kind of scenario, in an environment where instead of just demand switching driving a link to resid, you actually begin to have a pretty big supply volume that swings back and forth and could drive a link to residual fuel oil. So this for us is beginning to think about how do you actually play this linkage forward? What drives this linkage? Is it only demand side? And is there a supply side driver to this as well? So that was this is one path through it, and I wouldn't say this is a McKinsey point of view. This is something that we have our own fistfights internally on. There's a substantial debate on if this is the status quo world, what does an alternate world look like? And an alternate world, you can imagine looking at this chart, is one that says this demand doesn't grow. This demand is further to the left. If it's further to the left, I don't rely on that LNG at the margin. If supply, indigenous supply, is larger, it shifts out to the right, and I don't need that LNG at the margin. The other variables that come into play on this that impact pricing are, we talk about distillate and we talk about resid. Those are outcomes of crude oil pricing and refining margins. So as crude oil prices shift up and down, the position, not the shape, but the position of this curve shifts up and down. And as margins widen or tighten, the relative ratio of those to WTI moves as well. So for us, this is a kind of a way to begin to take, when we sit down with our clients, all of these various moving pieces and begin building a perspective that helps to play forward what actually drives this linkage in the long run. So with that, I thank you, Kim. Sure. Great session. Thank you very much, Steph.
We'll open the floor for questions for all of our speakers at this point. So, we'll get the other speakers up here. Thank you.
Yes, I have a question for Eddie or all of the speakers, and that is, I was very interested in your scenario you just painted, and I have actually thought about that same scenario, but let me throw out an alternative scenario. What if resource access and geopolitics and resource nationalism hit oil much harder than natural gas, because natural gas needs a commercial solution? It's much harder. You have to allow international oil companies to come in and help develop these projects. So in that world, you would expect to see much lower gas prices relative to oil prices, because you can't really have an oil supply response, but you can have a gas supply response. That's one thing. Let me throw out another alternative hypothesis, which actually argues the exact opposite. My other alternative hypothesis, I have two hands, and that is, what if the relationship between, the long-term relationship between oil and gas is on the supply side, but it's in relation to the replacement cost? You know, we spend more money as oil prices go up. We bid up the cost of services. It affects gas just as much as oil. So you'd expect them to move up and down together. So anyway, comments. Have anyone actually looked at these hypotheses and run scenarios or tested them or tried modeling this at all?
We'll start down there and then we'll work this way or work the other way.
You guys go. We haven't thought about that at all.
Okay. So we do actually do, when you begin looking into the services space, a substantial portion of, I think somewhere in the order of 60 to 70% of wells drilled every year around the world are still drilled in the US and Canada. So if you begin to play through that environment of what drives service cost, a lot of it actually still does come back to what happens in the US every year. We drill 1,000, maybe 1,200 wells a year in the Middle East, and yet it represents, 50% of our supply, an enormous portion of our supply relative to the amount of activity. So what tends to happen is on the service cost side, kind of the back end of that argument, a lot of it does tend to be driven by what happens in the US, more so than geopolitics or global access factors, just because they represent such a small portion of the activity base, even if they're a very large portion of the overall cost or overall supply.
I guess one comment I'll make is we found this important role for the heat rate variable. So if you think that the supply side's driving it, I mean, why would the heat rate variable relative heat rates play some role in explaining this cointegration relationship. I guess is the first point. The second point is related to that, and also to what Tommy was saying, is that our analysis would show that if the prices get sort of way outside this band of where you got some grid level switching between these two types of plants, then you would indeed be driven to a corner where you're only using, say, the gas plants, or you're only using the oil-fired plants. So as long as you're in a situation where we're seeing both types of plants being used all the time, then we must be in this margin where they're remaining competitive. The third point is related to that is that you've got to remember too that all these plants are very different vintage. So if you look at Jenny's data, the heat rates are all very different, and so it gives you, it's not quite a step function like Tommy had. It's actually a much more, it's a more continuous margin of substitution between these plants. And plus you've also got, like I emphasised, this kind of capability to switch at the grid level right across the country at different relative prices, and because the structure of plants and so on has been put in place to respond to the normal basis differentials and so on in these different regions. It's a more continuous kind of function over a broader range. But the bottom line is that our analysis is still suggesting this very strong role for heat rates, which to me still says that we're still in this margin where demand is influencing this role.
I don't think that goes away. I think all these phenomena get overlaid over each other, and on net, it doesn't become obvious where you're going to end up.
So, I should have also say, both of the aggregate analyses found this important role for storage, and for weather, and for the hurricanes effects and so forth. So, there's certainly supply side factors would also. So, if we could measure some of these other things, I'm sure some of them would also layer in terms of these short-run deviations from this long-run relationship.
But I think what Marianne's saying, Marianne, and maybe we're just like not at that moment yet. There could be a moment in time when we had a war over Iraq that involved 5 countries in the Middle East, where the price of oil would go in a shock, but gas would continue to flow. And you might get to a point where oil was so expensive that this continuum you say that never happens, where 100% shifts the gas.
I'd say it never happened.
But ultimately, where else? Right?
Yeah, and I'm not saying it never happened. I'm saying it hasn't happened yet. But in fact, in the Tobit analysis, we had actually had the switching plants. As I mentioned, there were a lot of cases where a lot of months there where 100% were burning gas or 100% were burning oil. So you do indeed get this switching where for periods of time all the plants are burning one fuel or the other.
You know how it would show up in your model? If long term there was a much bigger gas supply response to a high price environment over time than for oil, it would show up in your model as gas storage would show up high every year. That's how it would show up. And it would impact the results you're seeing overlaid on top of the fuel switching.
And on the demand curve we were drawing up there, that in a very high price environment, the indigenous supply portion of this would begin shifting out to the right, and it would push the U.S. off of relying on LNG at the margin, and you would begin to fall down to kind of a coal floor and a gas-on-gas competition world. And now you have a very disconnected environment. You have and that may be part of the reflection in the forward curve of a kind of a $9 to $10 implied gas price if it stays linked to resid, may reflect some of that risk variable that is protecting against $150 fly up. The gas doesn't follow all the way because there are supply alternatives for gas domestically that don't exist.
Well, I was just going to say, it could be that we get into a different regime completely. These are always backward-looking models, right? We're looking at data from 1994 to 2006 or 2007. Now, if it did something like that happen, but then came back down again, of course, we could always dummy it out. But you have to remember that if the regime changes or something, then
well, that's
this is backward.
I'm suggesting a structural change.
Yeah, it could have,
That's one scenario.
Yes.
2 or 3 years ago, or maybe 4, natural gas seemed to be a more favored playing field for the speculators than the oil side. If you looked at the number of open interest and the trade was like 20 to 1 relative paper to actual LNG. And now it looks like the speculators have left that pit and gone to the oil and the gold pit. To what extent did you bring in or look at or think about how speculators' favorite playing ground affects these price relationships at different times, and bring that in? Because I think if you look at the data, I think the data from 3 or 4 years ago are probably distorted relative to today because of the relative difference in speculation in those two markets.
You know, we did not specifically look at that at all. If it is at any time evident in the futures market, like right now, because we're looking at sort of out, then it would, you know, that's the only way we would see it. But we have not specifically modeled that for the past, you know, whenever it happened. We don't have that in the model. But if it's going on now, it's very hard to get a handle on what's going on there in terms of how much of the volatility, for example, is due to people coming in and out. So we haven't done that. Just haven't looked at it at all.
It seems to me that we are undergoing a very significant regime change in gas. And the econometric analysis focused on the past when basically you had a North American gas market which was isolated from the rest of the gas world, and comparing those prices to basically oil prices determined globally. And now through the LNG linkage, we're seeing the globalization, the beginning of globalization in the gas market. And so the lack of rain in Spain or a nuclear plant shutdown in Japan reduces the supply of LNG available to the U.S. and affects the U.S. or North American gas market.
Well, we actually have a paper that talks about that, because one of the things that could happen is if the fuel switching abroad, like say there was no fuel switching capability left in the United States at all, but you know the Japanese are still burning crude oil, then the arbitrage is going to play itself out that way. So we thought one interesting sort of future research project would be to look at if the crude gas relationship was the same or different in international markets, and think about how that arbitrage might play out over time.
We explored that and a few other issues actually in one of the papers that's not on the table out there. So.
The other point is in the model that Ken talked about earlier in the world gas trade model, we have demand side, you know, we have this elasticity of substitution between the different, between oil and gas built into that model, and so these international factors do affect the relative prices.
Right, but not in the papers talked about in this session.
For the McKinsey guys, the solution that's underpinning your $6 to $8 is the 70,000 wells, right? So what are drilling per year? What happens if you're maintaining drilling at 35,000?
Then you end up in an environment where you're actually relying on that LNG at the margin. So basically what we tried to do with the wells was to solve and say, how many wells would I have to drill in the U.S. every year so that I didn't have to rely on LNG that had an alternate home. In this environment, there's a certain amount of LNG that Europe is full. LNG will still come to the U.S. Kind of, it's contracted, it'll come.
Wouldn't that have a pricing implication though, or you're saying it's sort of a one-to-one trade-off LNG to North American supply?
Well, I guess in that environment, the LNG that the U.S., the marginal LNG that the U.S. would be buying would have an alternate market of Europe, would be priced at residual fuel oil, and that would in fact become the marginal price setter for the U.S. environment. If we're able to drill 70,000 wells or more per year, we don't need that volume, and it's some sort of domestic production that's at the margin.
The other scenario, of course, is if the demand projections that we have do not materialize, then you don't have to drill 70,000 wells to be on gas and gas. You could get away with 40,000 wells on gas and gas, depending on how the 2015 demand scenario works out. I think what he's pointing out is that's one world where the demand is high and we are not able to drill enough and get enough domestic production. What happens then? Then we see a vision where not only is there a crude to gas price linkage through the supply demand side, there is a supporting linkage even from the supply side, strengthening that linkage.
I was going to ask a question, you may have answered it, Tommy. On your chart, your last chart, you had two tranches of LNG.
Yeah.
You had a tranche that was fixed, and then a tranche to the right, which kicked in at higher prices. And I was wondering, that tranche that was fixed was about 7 BCF a day, And I guess you're implying that's non-divertible LNG volumes that'll be committed to the U.S.?
And I don't know that I would say committed as much as what we did was began building up all of the supply of liquefaction that's likely to deliver into the Atlantic Basin, net out the portion that Europe is seeking to consume. So when we balance the European market, what volume does Europe want to consume? There is a volume that is left over. And it's roughly around 6 billion cubic feet a day, and obviously varies seasonally, but that's an annual number. And that LNG arguably I wouldn't call it fixed on a contractual basis as much as it has no other readily accessible home. And so it will come to the U.S., and arguably it should come to the U.S. at a marginal cost, right? The investment's already been made. It will produce, and it should flow at a marginal cost. The marginal cost for LNG is somewhere below $2. I mean, it's actually quite inexpensive. Much of it's produced with liquid. So that's where that fixed number comes from. And that's where we see separation of LNG into kind of two pricing tiers, a portion that flows at marginal cost and a portion that flows at an alternate market value.
No, I just wanted to say one more thing to this gentleman who asked about the volumes of traders in the market. Even if it has changed, if you sort of look at what the model's fundamentals are saying, it's still explaining the oil, and with all these other variables, explaining the gas price pretty well. So whatever the traders are doing, the fundamentals are still holding pretty tight, and so the futures market, whoever is in there, what the model says, taking all this stuff, fundamentals into account, fits what's going on. So they must not be distorting the fundamentals that much. Let me put it that way. If that makes any sense.
Michelle, did you have a question?
Well, a comment and a question, which is that if all the traders just follow the traders, then everything's going to look the way you would expect it to look, right? And I think that happens a lot, probably more than we would care to admit, especially when it comes to just the financial trades and speculative positions and so on. For the McKinsey guys, where's Russia? Do you have an implicit assumption?
Yeah, we do.
That Europe, that Russia is relinquishing market share in order to make the argument that you're making?
Yes. So embedded underneath that is an expectation that in the 2015 time horizon.
When we publish our paper on Russia next year, it'll make things very interesting.
Okay.
This actually is a place where, as Tobit pointed out, we have fist fights.
Fist fights?
Yeah, this is another one.
There's a view that says that Russia comes in and Europe does not need the LNG, and it flows here so that 6 to 7 BCFD expands, and that we move more to gas on gas. There's a view that says that Russia doesn't get their act together, they're smart, that they essentially understand that they can quadruple profitability by delaying projects. Europe needs the LNG.
And the numbers that we've kind of backed into are, Russia can actually afford to withhold somewhere in the range of 3 to 5 billion cubic feet a day of volume economically. The lost value in disconnecting from residual fuel oil versus a lost volume, that's actually an economic trade-off for them to withhold that volume. And I don't think they'll ever get to, personal point of view, where they consciously withhold it as much as, to develop the projects in a timely fashion means they're going to have to quadruple their investment and their ability to manage large pipeline and upstream projects over the next 10 years. And there's a challenge there of are they actually capable of doing that?
So it's a trade-off between Russians being able to discern and optimize commercial positions as opposed to 1,000 years of
talk to the Ukrainians. Talk to the Ukrainians.
European backyard, so to speak.
There's one other thing going on that also is a big argument that we're having, and that's about renewables in Europe.
Yeah.
The stability of coal and renewables, and if you really play out the expectation of wind, that dramatically decreases the demand for natural gas. So that's kind of another element that's thrown in.
The way I tell the story is the McKinsey team who serves the Russians think they can keep the oil price linkage. And the McKinsey team that serves the Europeans think that through renewables and energy efficiency they can break the Russians.
I want to just go back to the econometrics just briefly. Mine, you did not do an error correction.
We did.
You did?
Yeah, we did. Yeah, it's an error correction model.
Okay.
Yeah. It's the same, basically, very similar model.
Very similar model.
We were not working together.
But Jenny could not get hers to work with WTI. She had
Well,
to.
you know, I have a comment on that, actually. Well, how far does the data go?
92.
No, forward.
2006.
Okay, here's
July.
one thing, I should tell you this. We ran this model, we sent it to a journal, and when it came back, they said, well, update your data. So in the earlier, we were going to 2006, and we couldn't find any cointegration from 97 to 2006. So we had dumped our exogenous variables because they didn't go back that far, and we're trying to find a longer time horizon where we could find cointegration. So we found cointegration from, say, 94 to 2006. But then when we put a whole new years of data, the short series became cointegrated. So check it out. I was going to tell you guys that. Go to 2007, you might find cointegration. So, but it's an error correction model.
I think the other big difference is that we were working with monthly data as opposed to weekly data.
And we got a longer time period, so we had to have the heat rates to get cointegration.
Yeah, for the monthly, maybe, that's
And so then if I want to use your models to do a forecast forward, assume we don't get a change system. Do I get reasonable prices? Have you done that?
Well, I showed you the picture for the year,
That was
right?
10 years?
Ah, well, 10 years. Who believes the futures market going out 10 years?
I mean, your model.
But see, the model uses WTI. Futures prices for WTI going forward. You can use that, yeah. If you believe your numbers, you go forward, yeah. We didn't do that.
Because when they did the error correction model at EIA, there was a time trend in there.
Yes.
So we got
Yes,
results
that's
that were-
true.
And is there a time trend in yours?
No.
Not in ours, no, not in ours either.
In fact, we were at,
You
no,
were just with the heat rate.
exactly. So you don't need a
But
time
it's
trend.
non-linear. And that's the difference between,
No, so you just need to make an assumption about what happens to future heat rates.
That's
in
right.
years.
That's right.
We did
Well,
not.
once we do that, we don't need a time trend.
No.
Right.
Good.
Glenn, the other thing you need also is what happens to the light to heavy differential. That as you build coking capacity, that'll squeeze and shift up resid.
But if I just make some cost-based assumptions about the relationship between resid and WTI.
Plus heat rate.
What's the heat rate?
Evolution of heat rate.
Yes, then I should be able to do it. And have you done that?
I don't know whether we did that, not very far out.
We didn't do it probably 10 years out. We did it for 2-3 years out. Just
Okay, well, we'll do that. Let's do that and see if looks reasonable. Great.
Yeah. That reminds me of something else, Peter. Where's air quality in this? Is it just embedded in the magic curve, or?
Air quality.
Because the reality is that we have a generation fleet that is constrained.
Yeah.
Those generators don't run whenever they want to. I mean, it's just, in fact, very few of them run very much at all, really. So, how did you account for that?
We haven't got a measure of air quality, so I'm not sure. I mean, to me, it's still. I don't see that as long. I'll go back to my point. As long as you're using both types of plants, okay. I suppose your point would be this. Okay, let me think about this. So your point would be that as we change, say, the cost of SO2 permits or something like that, or NOx, it's altered also. It's also another factor that's altering the relative cost of running oil plants versus natural gas plants. And so, so if there's been a sort of a long run trend in that, just like the heat rates, it might be another variable that perhaps would have driven this relativity if we hadn't had the heat rates, or if the heat rates hadn't worked. But as you saw, I mean, on the results I gave, once you included those heat rates, even at the NERC region level, the evidence that those heat rates were able to produce a co-integrated relationship between the two prices was really, really strong. So so put it another way, there's no evidence at all, even at the NERC level, that there's some other trending variable that we haven't accounted for that is influencing this price relativity. The evidence is quite the opposite, that once you put in heat rates, that seems to account for this trending relationship in these variables very, very well.
It's exciting.
Yes. Maybe I don't understand what all you all were saying, but is this possible that you could take a forward projection of oil prices, relate it to fuel oil prices in Europe, and then get a LNG price for that situation where the U.S. has to buy LNG away from the Europeans and thus get an idea of how high the price might have to go in a shortage situation?
Yeah, if you believe all the assumptions that go into believing that U.S. would be a net importer of LNG on the margin beyond the piece of 7, yes.
So so you could lay out some forward curves and say, okay, here's maybe the high price.
Yeah, and you can pick it,
go to
$60, $70, whatever it be.
There is a qualifier in there, and that is if we have a situation where Russia does not produce and the Europeans need the LNG, it doesn't matter what the price is in the States. It stays near.
Well,
which is another scenario.
We probably got more problems than that at that point. A lot of other things to worry about. But in a normal type situation.
Go ahead. You mentioned 18% during a certain time period that was used for electricity generation. Or there was, there was cogeneration with electricity plants. What was the time period that you used?
Yeah, the 18% number was 18% of the dual or multiple fuel fired plants in our sample. 18% of them were cogeneration of the multiple fuel plants.
The 18% of...
Yeah, switchable, I'm saying multiple fuel.
18% of the capacity in the U.S. is switchable. 13% of that capacity is cogen.
Is that what they...
Okay, and given that assumption, you still don't see
That's right.
correlation between oil and gas prices? I just want to be clear.
We do.
No, we do.
You do? Okay, that's all right. That was what I wasn't clear. And then you talked about residual fuel oil. And are you looking at that from the industrial or for industrial power generation?
We used a wholesale price of residual fuel oil in our analysis.
Okay. And I'd like to ask Dr. Ugel, I'm sorry. Thank you. What were the assumptions in you seeing the long-term price?
To forecast it out, you mean?
Yes.
We were using the WTI futures price.
Okay.
And then we were using the monthly average, the seasonal weekly averages for the heating degree days and for storage and for the cooling degree days. So everything was kept at normal historical averages.
Okay. Thank you. And then for the McKinsey team, you had mentioned that you said it was less than a 5% chance that we'd ever get to $13
in 2018.
By 2018. What were the assumptions in that?
So that's basically based, that's the assumptions on that is basically the long-term gas price based on the capital markets view of it and the implied volatility from the traded options.
Okay. All right, thank you.
There was a lot of discussion before this session on industrial pricing, and you all didn't mention the industrial pricing, but Jenny and Peter, if you all could just mention what your findings were on the industrial side, because you took a look at the relationships.
So we took a look at 5 major natural gas users, industrial, but we didn't have the level of data that we were hoping for. It was kind of sparse, and so that was a problem that we struggled with, but it was very mixed results, I would say. A lot of not statistically significant. Some some industries, chemicals, we found responded to natural gas prices, but it was all very preliminary. We never made it real far on that, just because we didn't have a very good sample of the whole U.S. We didn't feel like we had a very good representative sample of industrial users. So that's still...
One interesting thing we did find, though, was that we found a significant positive effect of electricity prices on gas demand by industrials, which we interpreted to be strong evidence for the role of cogeneration. So when the electricity price goes up, the demand for natural gas by industrials goes up, but it's to generate power and sell to the power market.
One of the other things I was thinking about, Jenny, is when you took a look at the individual industries, that you, essentially looking at those individual companies, you found that many of them just stopped using gas and left, especially the methanol and ammonia. And that the ones that remained just didn't respond at all to changes in gas price because either they were hedged or it was a very small percentage of their overall
Total production.
total price.
Right. We found a lot of fertilizers, especially, that moved offshore. Several moved to Trinidad and Tobago, where the cost of natural gas is lower. But you're right. So even in industries that use a lot of natural gas, say steel, for example, a lot of it's used, first of all, for electricity and cogen. But secondly, since it's I mean, from an econometric or from an economic standpoint, it's a small percentage of their total cost function, so they're not as responsive to it as something like the fertilizers.
The commodity prices moving up as well.
Right. Well, we always try to use real prices, normalize them by the output price, but it's not easy to come by for industry level.
Take something like steel. Steel prices tend to go up at the same time oil and gas prices are going up.
But I think you have other data points, other shifting around. Steel producers just breaking down facilities and moving them to feedstock countries, or decisions by major industrials to relocate, in the Middle East because you've got favorable feedstock conditions.
One of the limitations, I think that's, one of the limitations we had with the data was that we were using interstate pipeline deliveries, and a lot of industrial users are actually off of intrastate pipes. So we actually had a fairly limited sample when we were looking at the data, so we gleaned what we could, but it was really not enough to make really strong assertions, I think. So.
Well, we hosted an AGA meeting recently, and while not much industrial load is served by LDCs anymore, for those that had been serving industrial load, they've just lost everything. I mean, there's really just nothing left, really, in the LDC business anymore. So, I mean, I think there are various indicators out there for sensitivity that you're just not going to capture. It's just different data points.
I guess once you take out methanol and ammonia, there's not much left.
Anyway,
it's epic at that point.
That's why we think demand's going to be flat. The reason actually I bring this up is because Glenn's here and EIA is looking at that other estimate.
Okay. Well, if there are no more questions, I would like to put the wraps on the day, and I hope you all have enjoyed it as much as I have, and thank you for coming and participating in the discussion.